In exercise 14-7, we will be looking at ratio analysis. Let's look at the information given to us. We've been given a comparative balance sheet, which means we have 2 years worth of information. We have cash, accounts receivable, inventory, and plant assets. The first 3 assets are current assets. We then have accounts payable, mortgage payable, common stock, and retained earnings. Accounts payable and mortgage payable are liabilities. Accounts payable is a current liability. Mortgage payable is a long-term liability. The last 2 items, common stock and retained earnings, are equity items. We've been told for the year 2017, we have net income of 25,000. Sales on account is 410 with sales return and allowance being 20,000. Cost of goods sold is 198,000. And we've been asked to calculate 4 ratios: current ratio, asset test ratio, accounts receivable turnover, and inventory turnover. So we'll go through each of these and then I'll explain what these ratios are and what they mean and what the significance is as far as managerial accounting is concerned and management is concerned. So current ratio is current assets divided by current liabilities. So the current assets are cash, receivables, and inventory. So you add the 3 numbers up and divide it by accounts payable because that's the only current liability we have. So it's just a matter of doing this calculation, adding up the numbers. So your 3 assets, 15, 70, and 60 add up to 145. Your one liability, current liability, is 50,000. And when you divide it, you get 2.9. The next is asset test ratio. In asset test ratio, we are looking at quick assets divided by current liabilities. The denominator is still the same. In the numerator, quick assets, of the current assets, we want the ones that are close to cash, which means will change into cash very quickly. Inventory is 2 steps removed from cash. Accounts receivable just has to be collected for it to become cash. Inventory has to be sold, it becomes accounts receivable, and then it becomes cash, so we don't include it. Another item that's not mentioned over here, that we don't have over here, prepaid expenses are always excluded from quick assets because prepaid expenses such as prepaid insurance, prepaid rent, they're never going to change into cash in the normal course of business. We expect to get a benefit from it, but we're not going to get cash. So those are excluded. So when I exclude my inventory of 60,000, let's see what happens to my formula and all the numbers. My ratio drops to 1.7, and in a minute I'll explain what that means. Accounts receivable turnover is calculated as net sales divided by average accounts receivable. Net sales is sales minus return and allowance minus sales discount. We don't have sales discount. So 410 minus 20 is going to be your net sales. Average receivables is the beginning receivable plus ending receivable divided by 2. So these 2 numbers over here, 70 and 60, you add them up and divide by 2. That'll give you your average receivables. So in the numerator we have 410 minus 20 gives us 390. In the denominator we have 70 plus 60 divided by 2, that gives us 65, and this works out to 6. Inventory turnover is calculated as cost of goods sold divided by average inventory. Cost of goods sold has been given to us at 198. Average inventory is calculated as 60 plus 50 divided by 2. Okay, now that we've gone through the motions of calculating these numbers, obviously if you know the formula, plugging in the numbers and coming up with the answer is easy. But the question is, what is the purpose of this? How do we use it in making decisions? So let's start with current ratio. Basically, what I'm concerned with is current liabilities have to be paid off. Current liabilities typically should be paid off using current assets. So for every dollar in liability, how much do I have in assets? Here it is 2.9, almost 3, which means for each dollar in current liability, I have $3 in current assets, and that's a very healthy number to have. So if someone is doing business with me, they should be very confident that I'll be able to pay my bills. Now, if someone says, well, what do you have in that current assets? How much of it is still inventory you're sitting on? A more aggressive ratio would be the asset test ratio. So here we are excluding inventory, we are excluding all the prepaid expenses, and then we are seeing how much is there to cover the current liabilities. It's 1.7, that's still a very good number. Basically saying for every dollar in current liability, I have 1.7 in quick assets to pay off that liability. Again, my vendors and suppliers should be very happy with these two numbers. It builds confidence. The accounts receivable turnover is basically saying how quickly I'm converting my accounts receivable, how quickly it's changing over. Okay? And inventory is basically how quickly I'm selling my inventory. So these two numbers are very significant, and this gives you an idea as to how I am doing my business in terms of selling and collections. Now, in this particular exercise, they haven't asked you for this, but I'm going to do a calculation and show it to you, and you will understand these ratios a little better with that. You take 365, which is the number of days in the year, divide by the accounts receivable turnover. Here again I do 365 divided by inventory turnover. So what this means is it's taking me 101 days to sell my inventory, and then it's taking me about 61 days to collect on the receivable. So it's a total of 162 or 163 days. So that's almost half a year from the time I get the inventory to the time I sell it and get cash from my customers. So in the numerator, we have 365, that number is fixed. In the denominator, we have the turnover ratio. Do you want a higher number or a lower number over here? Well, the question is, do you want a higher number or a lower number over here? How many days do you want to collect on the receivable? The quicker I collect on the receivable, the better off I'd be, right? So I want a lower number in the denominator, which means a higher number in the denominator in order to get a lower number over here. So the higher this number is, the lower your final result is going to be days to collect. Same logic over here. So once again, what we're looking at is a business needs to know where they stand as far as how quickly they can sell their receivables and how quickly they can collect on their receivables, which is when these turnovers become very important. You also want to see the trend compared to last year. How long did it take you? Compared to your competition, how long is it taking you? If it's taking me, if my inventory turnover is 3.6 and someone else has 2.6, well, then I need to be worried. If everyone is in the 3.6 range, then that's about how long it takes for inventory to move. So again, the analysis in this exercise, calculating the numbers is not the hard part. Analyzing it and explaining it to management, that's the challenge. Can you convince the management about some of the arguments you're trying to make?